Welcome to another back and forth. Actually, it's a financial 15. Lots of great information. We're talking credit card myths here. Look at 7 myths about your credit scores. We're going to tackle all that. You definitely want to stick around.
Yeah, with interest rates higher out there and people looking to refinance, a whole bunch of things. We have been talking about credit scores for a little bit today. We want to make sure that you know enough about it, and we are going to talk about the 7 myths that you should know that you have to deal with so that you have the correct credit score that you need. Now, if you want to find this video or any of the other videos we've had, please go to our YouTube channel and subscribe. Great content there. Easy to do, hook up fast as you can. You can also go to our Facebook page and like us there, or most important, visit our website at beckerorr.com. You've got blogs, you've got events, you've got videos, the whole 9 yards. That's what you need. But today we are dealing with 7 myths about your credit scores, things that you may think are true, but actually are not, and may have a positive or a negative effect on what you do with your credit score going forward. Clint, what is the first myth that most people don't know about?
Myth number 1 has to do, and this is a common one, checking your credit score hurts your credit score. It depends is the real answer. It really depends on how you're checking your credit score. It's not a universal yes or universal no, but that is a myth. It's not as if every single time you check your credit, it's going to impact your score. And we can walk through the differences here, Kevin, right? There's what they call a hard inquiry and what they call a soft inquiry. We need to know the difference. What is the difference between the two?
Now, basically a hard inquiry is if you're actually looking at doing something credit-wise. You're applying for a credit card. You're going for a mortgage. You're getting a home equity line of credit or a line of credit in any general sense. Those are hard inquiries. Those are the ones that actually go to check your credit score and make sure that you're valid and actively seeking credit to get this scenario that you want to deal with. Soft ones are, you're flipping through one of those websites and you just want to see where you're at. That's listed as a soft inquiry. You're not really looking to apply for anything credit-wise this point in time, but you just want to see what your credit score looks like. Those are the 2 big differences between them. And again, the hard ones do have an impact on your credit score, whereas the soft ones don't. But there's a period that we have to deal with as well on this sort of scenario, isn't there, Clint?
That's right. So you might be thinking, well, if I'm, shopping around to see who gives me the best mortgage on a house, I may have to do a little bit of applications there. Is each and every one going to count as a hard inquiry? And the answer is no. Most lenders will give you a bit of a window. You can see we highlighted there a 2-week period. So if you do all your shopping within that window, it counts as 1 hard inquiry on your credit report. If you take longer, it could count as multiple hard inquiries on the credit report. But you want to limit the number of hard checks on that credit report. That's a healthy activity and it helps improve your credit score. So that myth that every time you check your credit hurts your score, not really true. A little more nuance is required. If you do it within a 2-week window and you limit the amount of hard checks, it's really not going to be a big issue. So that's one way you can bust the myth and keep your credit score elevated. Myth number 2 here, Kevin, I'll let you tackle this one, minimum payments.
Yes, I need to pay the minimum to keep my score up. Well, again, this is another one that depending on where it is, there is a truth or there is a negative to it. Now, if you have small amount of credit, that's fine. But if you have many creditors and look at how much you owe compared to how much your debt's available here, that can definitely have an impact. I mean, if you got 6 credit cards, a home equity line of credit, a mortgage, and a few other things, and you're only making the minimum payments on those things, that is going to have an effect on what your credit score is, depending on what's going on. So again, as it mentions here, if you're carrying lots of debt and just paying the minimum, it might not be enough to improve your score because you're at that high debt level. And that's a big factor to consider when you're dealing with any of these things.
Yeah, in other videos, we've gone through a kind of a model of how they calculate the credit score. One of the factors is often what they call credit utilization. The idea being if you're at the brim, like you only have $10,000 available credit and you use $9,999 of it, you might not be at the max, but you're right at that limit. And if you're only making minimum payments and you're continually at that limit, that's going to be negative when it comes to calculating your credit score. So just making the minimum payment might not be enough. Now, if you have, $50,000 of room and you're only using $2,000, well, maybe in that particular scenario, the minimum payments might be enough to keep up your score. So the answer is it depends. It's more of a myth. It's not like a simple one-size-fits-all solution there. Another one that often comes up has to do with spouses. If you have a partner, well, then you share your credit report, right? As if a household has one credit report, and that is not really the case. It is per individual. Every individual has a credit report, which means every individual has a credit score. It's not a joint account. It's not shared, but there are a couple of exceptions, Kevin, right? A couple of areas where a spouse could impact your credit?
Yeah, definitely. Joint debt is the biggest one. And in most cases on that aspect is if you apply for a mortgage. If a couple gets a new home or something along those lines, that's a joint mortgage you're holding on to. That's where that'll affect your credit score. Same sort of thing if it's a co-signer. If you have somebody co-signing for a loan for you, getting a new car or something along those lines, again, there's an area. Same sort of thing when you're dealing with credit cards. I mean, I know there's a lot of people that one person issues the credit card, they get a second one put out there for their spouse. So again, that's more of a joint scenario. Those are all ones that do have that joint scenario that's going to deal with your spouse's credit report's going to be close to yours. But again, anything else beyond that, it's all individual going forward. So very few exceptions to the rule, but there are that scenario. So again, we consider this to be more of a myth that you constantly have the same sort of credit score.
Yeah, so technically it is still two individual reports. There's just a few exceptions where you could have an impact because of your spouse there. Another myth, we're getting to closing a credit card helps improve my credit. I should say off the hop here that, again, it's going to depend. But if you're in a situation where I close a credit card and it helps me control my spending, get things in order, well, then absolutely do that. But if you just want to look at it in terms of an absolute, like every time I close a credit card, I'm improving my credit score, that's not really the case. There's a few factors that go into calculating that credit score. One of them is the credit length, your history. So if you have a really long history, I had a credit card for 15 years and I've been making the payments regularly the whole way through, and then I get rid of that and I get a new one. So I no longer have that 15-year credit history. Now I just have a report for like 1 month or 2 months or however I've had that new card. That can impact your credit because it changes your history. So the length of time you've had your credit accounts matters, and closing a card and getting a new one could impact that score. Also, the credit utilization. We went through this example essentially earlier where if you have a higher limit but use less of it, that's actually better than using more of a smaller limit. And you can see the example on the screen there. So if you have multiple credit cards, let's say across the board, you've got 30,000 worth of credit available across those cards, and you close one, so now you only have 20,000 of available credit. Well, it's probably better to have 10,000 owing on a 30,000 limit than 10,000 owing on a 20,000 limit. That's the credit utilization factor. So because of the length and because of the utilization, closing a card doesn't always mean your score goes up, right? There's a little more nuance there. It's more of a myth. It depends on the situation. Anything you wanted to add to that, Kevin?
No, I think that covers it exactly. I mean, it's the length of time that you've had something does improve your credit score. And again, the amount that you're putting on there, those are two big factors. And I don't think most people realize that that's the case. So yeah, just closing the credit card isn't going to do it, especially if you're opening new ones or dealing with it in that format. But that's another one of the myths that's down, and that'll lead us going forward to another myth. Number 5.
Myth number 5 there. You can see it on the screen. It makes sense on the surface that if you have higher income, you're going to have a higher credit score, but not really. It doesn't always work that way.
No, that's exactly it. I mean, just because you have a higher income, if you've never taken credit at all, then you really have no credit history. Just because you have high income coming in does not necessarily mean that you have a good credit history going forward. One of the rationales behind getting credit history is you have to have credit to be able to do that. So having a credit card, having a mortgage, having a loan of some format, and if you consistently paid those off, you're developing a credit score. If forever you paid off everything in cash and never had to worry about credit, then you may not have credit history that's going to be as high as some of the other ones. So definitely when you're talking about it, higher income does not necessarily mean higher credit score. Chances are if you apply, you will do well with it, but that's not exactly the scenario where, oh, I have a high income, I must have a high credit score. No, that's definitely what we'd consider more of a myth.
And myth number 6, we're flying through here. Number 6 has to do with divorce. The idea that once I'm divorced, well, all my spouse's bad credit just out the window. Unfortunately, not always as clean cut as we might like. And you could still have an application there where it's going to be lingering. It's not automatic. And that's really the point that's highlighted on there. If you have joint accounts, let's say you have a joint mortgage, we talked about that, a co-signer earlier, something of that nature. And it's not automatically just going to be split once you get divorced. Someone's got to tell the credit bureau, someone's got to tell the creditors, and it has to go through. So it's best practice to make sure that if there's an asset, you sell the asset, you pay off the debt, you get individual accounts, you tell all the creditors involved, because it's not an automatic process. And if you don't, it could linger and you could have those spouses' bad credit habits following you even after divorce. So it's a myth. It doesn't go away automatically. There could be some work involved to take care of that. And that brings us to number 7 here, Kevin. It has to do with debt management programs. If I do a consumer proposal, if I go through a bankruptcy, some kind of debt management program, that's it. My credit score is ruined. Is that the case?
Yeah, again, this is not really a scenario. For a short period of time, yes, it does have an effect on what your credit score is. If you declare bankruptcy, you basically have a 7-year time frame after declaring bankruptcy where your credit score is going to be ruined. But after that point in time, you're starting from fresh and you are rebuilding again. Same sort of thing with a consumer proposal. If you've paid off the monies, if you've done things in line with the way they say to do it, after the time frame is up, you do start new and you can improve that credit score. So it is not a lifetime scenario. If you declare bankruptcy, Runch, that doesn't mean that you are going to ruin your credit score for the rest of your life. It's just a time frame. Everything has that sort of time frame scenario to it. As long as you don't continually declare bankruptcy every 7 years, you're probably pretty good in that aspect. But yeah, so debt management programs, they do have a purpose. There is a reason for putting them out there, and that is so they can save your credit scores down the road. That's a big factor going forward. So yeah, they don't ruin it permanently, but there is a time frame that it will be in jeopardy.
Yeah, you do a consumer proposal, you do an orderly payment program, bankruptcy. They're going to have different time periods there. Some may be 2-3 years. Bankruptcy would be the longer one, the 7-year time frame. But essentially, while you're tackling that, your credit's going to be out the window, but there will be a time where you'll get the opportunity to rebuild. It's not permanent. It's not forever. So we tackled lots in a short period of time there. We've done other videos on credit. I think it's timely. That's why we're trying to bring these out.
Yes.
7 myths. If you have questions, let us know. You can go to chatwithclintonkevin.com, fill in the form. I'd absolutely love to hear from you. Anything you want to tell the folks before we go, Kevin?
No, I think that we've covered it there. So yeah, if you have questions on credit scores, I mean, we ran through these myths pretty quickly, but we do want to help you out with anything that's going forward. Please contact us. Otherwise, we will come back with probably more credit stuff later on down the road. Maybe this year, maybe next year, who knows? Otherwise, I think we've done it well for today.
Take care, everyone.